Okay, we're going to be talking about Bitcoin mining. Surprise, we got Mike Cohen of Power and Ben Harper of Luxor joining us talking about the financialization of Hashrate. Do you just want to take that away first,
Sure.
Mike, and explain what that is?
The financialization or hash rate or all of it?
We'll just start with Hashrate. What is Hashrate in the first place, and why are we throwing dollar signs around on it instead of just pure BTC?
Well, hash rate's the computing that validates transactions on the Bitcoin network, but why does hash rate have a value? Well, it represents a conversion right to Bitcoin. And so because it will eventually become Bitcoin and because there's a financial market for Bitcoin, then logically there should be a financial market for the hash rate and it has a value.
There we go. The simple answers on this panel. Okay, so we're going to be going through why we need to think of hash rate and Bitcoin mining in terms of a financial lens. This is probably pretty intuitive on some levels, but we're definitely going to go through some of like the more nuanced parts of this, whether it be like an index strategy like Luxor has with their hash rate index, all the way to like how some of these markets actually are kind of have first been born with Bitcoin mining over the last few years, because what you said sounds pretty simple, but it didn't exist a few years ago, and I think it's taken a little bit for this market to grow. I mean, it's been around 10-ish years, but it's changed, and it changes every year. So we'll start off just kind of talking about through some definitions. I'm going to throw it over to Ben. Walk me through a little bit how you guys at Luxor think about hash rate, what you guys are trying to do, what sort of products you guys build around hash rate specifically.
Yeah, so we think of hash rate basically as just a compute commodity. Same way electricity is a commodity, a hash is same no matter where it's produced all around the world in terms of its ability to produce Bitcoin, which is what is rewarded. And so at Luxor, we really see it as part of the commodity story. Not the only commodity, obviously, in the space, Bitcoin being its own commodity, Blockspace being another commodity, but hash rate definitely being a commodity we're very familiar with on the pool side. Because if you think, what is a pool? A pool is really a hash rate market where data centers are selling their hash rate and they're being compensated in Bitcoin. And I think that's kind of the biggest misconception about the industry is people think Bitcoin is the product that's being produced by these Bitcoin miners, but really what they're producing is hash rate, compute power, and they're being compensated with Bitcoin. So the same way a baker produces bread and sells it for dollars, they're not a producer of dollars, they're a producer of the underlying commodity. And so we really look at it as a compute story and a commodity story.
Yeah, and part of that, too, of the commodity story is it's plagued with all the same issues that other types of commodities have had in terms of like revenue predictability. So in agriculture or oil and gas, they have issues with revenue predictability. Whether it's crop yields and weather patterns for agriculture or the production from a well and other macro events. And so, there's no reason that hash rate and as a result, Bitcoin shouldn't be commoditized and shouldn't have the same types of tools that other commodity producers have access to.
So the story with hash rate this year is that it's like the dollar per terahash, or the value you're getting is pretty low. Like we're like $52, so low.
Just all-time lows a couple weeks ago.
Yeah.
47, 6-ish.
44, yeah, 44.4 cents.
It's even worse than I thought. That's not good. So why does that matter right now? And how do miners respond to lower hash price?
Well, a lot of public miners have responded by trying to diversify and going towards AI and stuff. But I mean, that is one strategy. But we're inherently long Bitcoin by being miners, and I think one of the mechanisms that we can use to better predict revenue is creating financial instruments that are based off of hashing power itself. And so, we're working towards helping existing market venues package and offer hash rate products. And Luxor has a different approach. But, I think it takes a multitude to create this market, which unfortunately right now is still very thin.
Let's not jump quite ahead to the
Sure.
products you're doing. I do want to ask about that, though, and we'll go through the different ways of doing this. But from a measurement perspective, you have a few things you're taking into account: Bitcoin price, difficulty, machines. from Luxor side, you guys have your hash rate index. Tell me about that product itself, how you guys are measuring hash rate. What are some of the things that go into this index and make it work?
Yeah, so there's four things really that go into the index. Their Bitcoin price, which is the one everybody's familiar with. That's the price of Bitcoin as an asset. Network difficulty, which is really just a word for however many other people are mining, how much other hash rate is out there. More and more, the interesting one is transaction fees, what people are willing to pay for block space, and then ultimately the block subsidy, which is it is a variable, but it's also perfectly predictable. So there's not a ton of excitement around that area. Why do all four of these matters? Why do you have to measure it? It's because hash rate is the actual commodity you're producing, and it has a value based on those variables. If you're just, for example, using Bitcoin price to hedge, which is great for your treasury, but it doesn't actually, although it's related to the value of hash price, it's not the same. And so, let's say you're in a situation, you could be curtailing operations, and so you go, buy hash price contracts. You could be perfectly hedged for what you'd be missing out on. If you were to just buy Bitcoin price, you could be in a situation where transaction fees go on a tear, and you're not hedged, and you're not being compensated for any of that risk. And so the calculation really matters. The inputs really matter because they're native to the actual asset you're producing. So I hope that answers the question.
Yeah, and to Ben's point, I mean, it doesn't perfectly, or a traditional Bitcoin option doesn't completely encapsulate risk. And we're seeing that now where Bitcoin price currently is doing well, not bad, but we're seeing all-time lows in hash price. And so that disparity means that, despite Bitcoin doing okay, mining revenues are low.
Tell me about transaction fees over this last year and why that has mattered for the hash price. I'll throw it back to you, Mike, first.
I mean, there's a lot of hype around fees, especially near the halving for ordinals and runes and all that, and hasn't sustained itself seemingly, and maybe it'll come back. But I think the ultimate objective is for a fee market to come out of this, and the subsidy won't be around forever. So I don't know. I didn't really have a conclusion there. What was? Maybe repeat the question.
I'm just interested in what you think about transaction fees, but I'll toss it over to Ben unless you have.
Yeah, I'll jump in on that because I think
that was a great overview, though, Mike.
Transaction fees are actually, I think, the most interesting part of the hash price puzzle right now. I mean, obviously, Bitcoin price really matters to mining operations, and it's what people are really watching. But it's that market activity and transaction fees that since somebody should start a media company about Blockspace, but it's become since ordinals, a couple of these other L2s and exciting projects that are going on, there's quite a bit more demand for Blockspace, which is increasing volatility in the transaction fee market. And it is just the most interesting part of, I think, the equation because of that volatility. The fee market functions a lot more like energy markets in that what's happening today isn't necessarily as related to tomorrow as an asset like Bitcoin or oil, for example. And what do I mean by that? Well, other energy products like oil or discrete products, Bitcoin, my best guess of what it's worth tomorrow is what it's worth today. But with electricity markets and with block space, you could have a very volatile event today that doesn't necessarily move expectations in the future around what future block space will need. And so you get this capacity type market where you have huge volatility. And with huge volatility is trading opportunities, risk, all those things.
And there's almost a perfect analogy also to what Ben said, is that the fees are a factor of congestion. And the same applies in other commodity markets like gas. Natural gas contracts are priced differently based on where and how they deliver, and they're you have, for example, pipelines that have more capacity in one place or less, and so congestion plays a factor there.
So for different derivative products or products that you can build out of this, we have hash rate products themselves. You guys have a future and some hedging strategies, and then you guys are building some tooling as well.
Physical delivery, yeah.
Physical delivery for these things. Walk me through those, Mike, first to you, and then Ben to you. Let's just talk about those products, and then from there we'll talk about I have actually some questions on transaction fee products, but we'll get to that in a minute.
So essentially what we're looking to do is not build the market, but build the tools so that existing marketplaces can offer hash rate products. Much like exchanges often don't manage their own custody, if they were to offer a physically delivered hash rate product, they likely wouldn't manage their own hash rate. And so that's kind of the piece that we provide, like clearing and settlement of hash rate contracts.
Awesome. And then for Ben, you guys offer a wider breadth of things and just launched a new product on Binomial as well.
Yeah, so last 2 years we've launched 3 different hash rate contracts, 2 OTC, 1 deliverable, 1 non-deliverable forward, and then we just launched an exchange-traded future on Binomial. Ultimately, it's the same underlying asset, hash rate. It's just different ways of getting exposure, different counterparty risks. For exchange-traded products, your risk is to a regulated exchange. On the OTC market, it's a bilateral risk you have there. And I think the most interesting product, at least that we have, is the upfront payment deliverable forward, because it's a way for mining companies to get financing and use their existing hash rate essentially to expand their operations. And you asked earlier about hash price being at all-time lows. What does a miner do? Well, there's 2 things you can do, right? If on the cost side to increase your margins, you can reduce electricity costs, or you can increase fleet efficiency. And so getting that financing to upgrade your fleet is really important, because just looking at things on a hash cost or a hash price basis misses that efficiency angle. And although I think we'll continue to see all-time lows over time in terms of hash price, but that's not necessarily, if you convert that to dollars per megawatt or dollars per gigajoule, it doesn't necessarily, we're probably not at all-time lows, because the machine hardware gets better and better and better at producing.
When do we see something like using your future hash rate and using that hedging product to build out future mines actually happen? Do you guys have any examples of that at Luxor, where you guys have been able to sort of help someone build out a future mine or future capacity by selling into the future? Yeah,
we do it every day. We basically work with mining operators, especially after the halving, heading into and after. Getting that efficiency, the joules per terahash down for your fleet is critical, and financing is hard to get in this sector. And so with our pool and ASIC desk, we're able to get really attractive financing terms for 2 reasons. One is that all of our deliverable markets are Bitcoin denominated, which ASIC loans in the past did not have. You had to pay back US dollar, and you might not necessarily been able to produce those US dollars because of market forces. When it comes to Bitcoin, and we're paying in Bitcoin, a Bitcoin miner is a lot more creditworthy to be able to carry out that activity. And finally, you're using existing hash rate that's already on Luxor pool or already on some other pool. And so there is a delivery history that you can see. And essentially you use those 2 things, and we're able to basically say, we know somebody who mines with Luxor, they've been mining with us for this many years, we know what their fleet is, and we're able to evaluate their counterparty risk and basically get them the funds up front that they use to go buy ASICs. And so it's really a financing mechanism.
Okay, awesome. Mike, back to you for you guys and what you're doing with the delivered hash rate. How are you guys thinking about this hash rate market, and where would you guys want to go from here as a self-miner? Because Power mostly is just self-mining, correct?
Yeah. I mean, it's how we started, and I think we've identified the need early on because, as being a miner, we experienced many of the pain points that other miners have and thought that this was a need. It also had a tech stack that could provide it. I mean, the way that I see it, I think physical delivery of contracts and true price discovery is important. An index is good, but it makes certain assumptions, and it's assumptions that like physical delivery in a true deep market couldn't really encapsulate. So, we're looking to onboard exchanges and market venues to help offer this product, and we're open for business, I guess.
You're open for business. Love it. Okay, let's go to the buyers and sellers for this. So I think the sellers are pretty obvious. It's miners.
Miners for the most part, but I mean, if there were a thriving market, speculators could be sellers themselves, but buyers can be obviously intuitively people speculating on the value of hash rate, and anybody really looking to outperform Bitcoin because ultimately, like the thesis behind Bitcoin mining is that you're accumulating Bitcoin below spot, or at least more often than not, acquiring Bitcoin below its trading price. But with a hash rate contract, the analog would kind of be like a call option on Bitcoin, and a call option that is maybe mispriced. So recently, I think Luxor's derivative was trading above. There was a premium to hash rate, but there was also like a lot of open interest on calls and a historically high premium. And so, that premium being lower than what the premium on hash rate being lower than the premium on the call, you get the same exposure, but in a different way.
I think where we see the market, kind of going is it will be more and more in line with those other markets. That the buyers and sellers are probably the most interesting part, like you said. So sellers, natural sellers, but there are quite a few speculators actually, and the market's been growing pretty fast. On the buy side is where you get the most questions, like who's buying hash rate. There's a assortment of answers to that. It's actually far more diverse than we expected when we first kind of launched the product. So who would be a natural hedger? Any hosting operation that promises uptime when you're down has basically short position that you can hedge by going long. Any investment fund that is holding Bitcoin, and there's a lot of them around the world earning nothing on their Bitcoin, are looking for Bitcoin native ways to generate return on those holdings. And so hash rate is a very natural place for that to happen. And then there's also the natural buyers and sellers in the connected markets, right? So different financial institutions might want to go long Bitcoin price, and that liquidity flows through, right? Because these markets all trade against each other. And then on the exchange side, anybody that needs Blockspace in the future would want to go long transaction fees, and hash rate contracts and trading hash rate contracts against transaction fee contracts are a way to get that liquidity. And then the final one is there are lots of miners that want to get even longer hash price. They get into mining because they're bullish on it, and this is a way for them to get even more bullish. And so the buy side is very interesting because you have a very diverse set of participants.
Yeah, meeting targets, for example, through a hash rate contract.
I'm going to ask kind of an ignorant question just because I can. So why would a big fund not purchase a hash rate contract and be purchasing Bitcoin at a discount with hash rate and mining versus just going and buying spot like you see currently today with like these Bitcoin ETFs, for example? Open for both of you guys. We can start with Mike.
Counterparty risk is a big one, I think. Like there's, if you buy it directly from a miner, the fact that miner may not be online, you have to have somebody or someone in the middle to guarantee that hash rate will be there when it's needed for a physically delivered product. So I think that is a necessary piece. And I don't know,
So the question is why or why not?
Yeah, why not if you're... okay, this would probably never happen, but for sake of argument, why would a Bitcoin ETF, if they're trying to source Bitcoin, not enter into one of these contracts and get Bitcoin at a discount?
Right now, regulation, I think, unfortunately, they can't. But that if that changes...
Yeah, I'd say it's two things, right? It's price risk and counterparty risk, which Mike said, right? Price risk, you buy hash rate, it works out well for you if hash price ends up being higher than the price that you purchased it at, but then it could also not work out well for you if it goes below. And so for a fund that has to be holding a certain amount of funds, they want to be taking some pretty not risky bets, basically, right? And then the counterparty risk is the even bigger one. You give your money out to a miner, you have to be confident that you can get that back, especially as a fund. So I'd say price and counterparty risk are the reasons, like an ETF, for example, wouldn't want to purchase hash rate contracts.
Gotcha. Okay, I got two more questions for you guys. One, just more of a speculative side of like these financial derivatives that we're seeing. A new project called Alchemia launched this week, and they basically enable you to have a DeFi-like experience trading transaction fees. So that you're basically entering into the game of volatility with transaction fees and seeing if you can like long or short it and make a bag the game for that is either professional speculators, wallets that want to have some inclusion into Blockspace, or for miners who want to hedge out their transaction fees. Transaction fee markets are really small, typically like 1% to 2% of Bitcoin rewards, but there has been times where it's even larger than the Coinbase rewards. How do you see this market developing for transaction fees? Is there going to be a derivative market for it, and do you think it could be ever robust in any sense?
Yes, I do. I think we'll see more activity on the blockchain with ordinals, with these L2s, different protocols that are being built on top of it. That creates more value for the block space, more demand for that block space. I think you'll still see miners, though, hedging in hash rate markets, and you'll see like exchanges and custodians and people who really need block space hedging in transaction fee markets. And then you'll have a bunch of market makers basically making sure those markets don't get too far away from each other, because the value of hash rate is dependent on all of those factors we laid out: Bitcoin price, transaction fees, difficulty, block subsidy. And so because hash rate is really core to what a miner needs to hedge and where they need exposure, I think that's where they'll be most involved. I think you'll see mostly exchanges and speculators on the block space side, and then there will be some smart market operators and smart market makers in the middle, basically making sure those contracts don't get too far away from each other. So that would be my view.
Any thoughts on the initial question?
No, I think you caught it all.
Nice work. Very good work. No, I think that market's pretty interesting. I'm excited to see if it does develop. I would assume right now it's just so volatile that you kind of have to kick that market off and then it develop during intermittent moments. But besides that, there's not much to do. Let's kind of finish up with talking about hash rate financialization in terms of energy and how this could help underpriced energy. Is there any sort of angle there where having a robust hash rate marketplace or a place to buy hash rate does help fill in some of these cracks for the Bitcoin mining market? Or is it...
I mean, I think Bitcoin mining, period, is great for subsidizing different renewable projects or stranded energy projects. But really, where hash rate markets and hash rate contracts come into play is giving better visibility to the off-takers in those contracts. Because essentially, for a new renewable installation, you would be improving project finance economics, but that may not remain true if the revenue predictability and quality of revenue of that operator is uncertain. And so that's really what we're looking to provide here, is certainty for the operator.
Awesome.
I think they're completely critical. To do any kind of giant energy infrastructure takes enormous amounts of capital, larger and larger amounts of capital. And capital wants to de-risk operations and earn predictable returns. And, for a Bitcoin miner, you have sort of three risks, right? You have your treasury, which a lot of them hold Bitcoin, so they have risk on that front. They have their energy. A lot of them have PPAs, different energy hedges. On the revenue side is kind of the last piece of the puzzle. When you have a forward market, you can lock in and you can create certainty around those three price risks that I just talked about. You become a very investable infrastructure and energy operation. And I think without those things, we'll still be a very immature industry, because real capital that's looking for more predictable returns won't come into the space. But I think now with these tools, it allows you to, and of course on the, just on the functional side, we all kind of know the story of flexible compute and how that monetizes. But without those forward markets where investors can get certainty in your operations in the future, which is what an investment is, I think they're absolutely critical for scaling this industry.
Yeah, I mean, energy investors are not as big risk takers as Bitcoin miners. And so...
Shocker.
Yeah.
Okay, well, we got about 2 minutes left, so I'll leave the floor to you guys. Anything from Power or Luxor you guys want to leave the crowd with? Mike?
Yeah, I mean, I think these are needed. I think also another very important and interesting component is hash rate centralization or mining pool centralization, which is becoming, increasingly a concern. And I think that one of the elements that could fix it is delivery of hash rate and enabling the beneficiaries of that hash rate to basically make a decision on where that hash rate should end up. Which, you have these trends where there's always going to be kind of a force towards centralization and consolidation in any market. And even if that happens for Bitcoin, if we find a way where the economic interest can remain decentralized, maybe it's not as big a concern, or it's like one way to alleviate it.
Yeah, I think kind of an assumption that was right up until recently is, these were nascent new markets. I think the takeaway I'd have for everybody here is that these markets are now large enough for any miner in the world to participate. Anybody can get a few exahash off now, and that'll be up in the tens of exahashes soon. And so, like, my main message would be that if you're a miner, you need to be looking at this, because there are miners that are getting financing at more attractive rates. They're expanding their operations, and they're de-risked far more than the industry. And it's happening at large size on the buy side and the sell side. And I think that's going to continue. And so, my message would be that the size is there. And that's a new thing that's really happened in the last year. There is now thousands and thousands of Bitcoin of liquidity, and so there's really size for anybody to start playing in these markets. I think a year from now, when we're sitting on this stage, almost every single major producer will be using these instruments.
Yeah, access to capital is sink or swim. So,
awesome, Mike, Ben, thank you so much for joining us today.
Thank you.
Thank you.
Next year, we are bringing the Bitcoin conference to the American West, Las Vegas. The brightest minds in the world will converge to deliver Bitcoin history. Buy your tickets now at b.tc/conference/2025.